JPMorgan's step to include India's sovereign debt in its global indexes from June 2024 is widely forecast to bolster capital inflows into the country's financial markets. Global money managers, which need to earmark their international investments according to the weightages in the JPMorgan indexes, will need to now set a certain proportion of investments for Indian bonds too. Now, according to JPM, 23 Indian government bonds will become eligible, and these have a total notional value of $330 billion. And these would be index eligible. And the inclusion into the JPM indexes will be spread over a period of 10 months. And the maximum weightage which the Indian bonds will have in the JPMorgan index will be 10%. So it is 1% a month over which this would be staggered. Now, in the past, offshore hot money which has flowed into the Indian markets has been a vulnerable part of the Indian financial markets, because this money tends to move out very quickly whenever you have episodes of shock developments globally. And we have seen this in the past in 2008 when the global financial crisis broke following the collapse of Lehman Brothers, in 2013 during the taper tantrum episode, in 2020 when the COVID-19 pandemic broke out, and more recently in 2022 when the Russia-Ukraine war broke out. Now, according to Edelweiss Mutual Fund, about $21 billion of inflows is expected to flow into Indian government bonds by March 2025. That's a 10-month period. And the key advantage of the inclusion will be that this would cushion India's capital buffers to deal with any external shocks. And we've had the forex reserves of the country, they've hovered around $600 billion, and that's kind of kept our capital position, our external position strong and resilient. Now, more money is expected to flow into the country from the middle of next year, and that is something that is going to bolster India's capital position.